Welcome back to The Deep Dive, your go-to source for unraveling the most important nuggets from today's financial intelligence. Today is Wednesday, August 13th, 2025, and we're diving deep into the latest market moves and what's really driving them. The big story, U.S. inflation. Showed some surprising moderation, actually, in that news. It's a real surge of optimism through equity markets. It's fascinating how quickly sentiment can just flip with new data.
It really is. And what's truly significant here, I think, is how this one piece of data is shaping expectations for what the major central banks might do. It ripples through everything, bond yields, currencies, globally. We'll try and connect those dots for you today.
Okay, sounds good. Let's unpack this then. So the heart of it is the July U.S. consumer price data. It showed just a 0.2% rise for the month. That brought the annual inflation rate down to 2.7%. Now, that was a bit below expectations, and it really got investors paying attention. The immediate takeaway seemed pretty clear.
Yeah, absolutely.
With inflation cooling off like that, investors are now, strongly anticipating the Fed might cut rates, maybe as soon as September.
And that's exactly why it matters so much. This moderation, it signals that inflation is, actually moving closer to the Fed's 2% target, which is the goal, right? What's fascinating is how the market pricing shifted. It now reflects roughly, a 70% probability of a 25 basis point cut in September?
That's 70%.
And they fully priced in a second cut by December. So the market's basically saying, okay, Fed, we think we know what you're doing next. And they're betting on it.
And the markets just loved it. The S&P 500, it pushed up 1.13% to a record close, 6,445.76. The Nasdaq Composite climbed 1.39%, also a fresh closing high, 21,681.90. But what really stood out to me was how broad the gains were.
Right.
Communication services, tech, financials, they all led the rally. Even the Russell 2000, the smaller companies, domestic cyclicals, it gained nearly 3%.
Yeah.
That really shows widespread risk appetite, wouldn't you say? Not just the usual big tech names.
You're absolutely right to highlight the breadth. That suggests some real conviction.
Yeah.
Usually when you see a broad rally like that, it signals maybe a deeper confidence in the economy. Not just chasing specific growth stories. It feels like a risk-on environment for sure. But the question is always, how long does it last?
That is the million-dollar question, isn't it? And speaking of insights, making sense of all this complex real-time data, that's where tailored intelligence is just so valuable. That's why we're grateful to Nextsight. They're an amazing intelligence company behind these insights. They craft them using their open-source intelligence platform, Site Connect. They build and customize intelligence reports specific to what each client needs. If you want to explore more, check out next-site.com.
Okay, so let's look at some specific movers that really illustrate this trend. Alphabet shares, for instance, they rose 1.2%. There was this report that a startup, Perplexity, offered like $34.5 billion for Chrome.
Wow.
Yeah, for the browser. That definitely sparked some speculation about asset sales. It's a huge number. Yeah. And it's not just about Chrome itself. It's maybe the market signaling that even these giants might need to unlock value in, unexpected ways. Maybe a shift towards optimizing core assets. We've seen that narrative pop up before.
Interesting point. Then there was Intel. Jumped 5.6%. Pretty solid. That came after former President Trump praised their CEO, Lip-Bu-Tan, and suggested prioritizing domestic chip manufacturing, hinting at maybe some bipartisan support for subsidies down the line. That could be a significant political tailwind.
Oh, absolutely. Geopolitics and industrial policy, they're increasingly driving valuations, especially in strategic sectors like semis. Intel's jump isn't just about one comment, right? It's the market pricing in the possibility of government support for domestic production. That could really change the game.
And U.S. banks like J.P. Morgan, Bank of America, they advanced too, collectively up about 2.1%. Seems like it was mostly due to that steeper yield curve helping their margin prospects. Plus, investors seem to like the recent Fed stress test results.
Right. And just to clarify for listeners, that net interest margin, or NIM in T, it's basically the bank's profit spread, the difference between interest earned on loans and what they pay on deposits. So a steeper yield curves where long-term rates are higher than short-term ones, that directly boosts profitability. It's a huge driver for bank stocks.
Good explanation. And check this out. The Dow Jones U.S. Airlines Index surged a whopping 8.87%. The CPI report showed airfares actually rebounding 4%, which eased some of those travel demand worries. Plus, lower fuel prices helped too, I imagine. Seems like a collective sigh of relief on the travel front.
It does. What's fascinating here, though, despite the overall slowdown in inflation, certain core services are still pretty sticky.
Sticky, meaning?
And they haven't come down much. Think shelter costs, auto insurance.
Right.
It's the kind of inflation that's, well, really tough to bring down quickly.
Ah, okay. So even with the good headline numbers, the Fed's job isn't quite finished yet, is it?
Not at all. That stickiness suggests the Fed might, want to wait and see more confirmation, like the upcoming producer price data, personal consumption expenditures, before they actually make a move. It's not a done deal, despite the market getting excited. They want broad, sustainable disinflation. And those core services, still a bit stubborn.
Okay, let's move beyond stocks for a minute. The bond market. 10-year Treasury yields actually edged up a bit to 4.29%. But the 2-year yield slipped down to 3.73%. So that movement steepened the yield curve.
Right. And as we touched on with banks, a steeper curve is generally seen as positive for financials.
Right.
Wider difference between their short-term borrowing costs and long-term lending rates expands those net interest margins. It's often seen as a sign of maybe economic recovery, but here, it's mostly driven by the expectation of Fed cuts on the short end.
Got it. And that rate cut story also hit the dollar, right? Noticeable weakness there. The euro climbed to 1.1666, sterling up to 1.3495. The yen strengthened to 147.74 per dollar. The U.S. dollar index itself, it's down 0.62% just in the past 5 days, and down quite a bit, 8.8% for the year so far. That's a pretty strong trend.
It is. And if you connect it to the bigger picture, the dollar slide, well, it's accelerated as U.S. rate cut expectations are running ahead of Europe and Japan. Makes other currencies look more attractive from a yield perspective. But it's worth considering this decline could pause or even reverse. Say if U.S. economic data surprises to the upside or if global risk appetite suddenly fades, then you might see a fight back to the dollar's perceived safety. So it's definitely something to watch.
Always those cross currents. Okay, switching to commodities. Oil prices pulled back a little. Brent crude slipped 0.77% to $66.12 a barrel. West Texas Intermediate, WTI, settled at $63.17. That was down 1.24%. Seems like signs of softer demand are weighing. Though it's worth noting WTI is still up, nearly 13% over 3 months, but down almost 9% year to date. Gold hovered around $3,348 an ounce, and Bitcoin traded near $118,725. Still showing a pretty strong gain for the year, over 22%.
Yeah, oil's interesting. Despite all the geopolitical tensions, it's staying pretty range-bound. It seems like demand concerns like China's slowing property market, maybe some tepid U.S. gasoline use, they're offsetting the supply risk right now. Plus, you have disciplined U.S. shale producers and OPEC Plus ready to adjust output. It's like the fear of a global slowdown is currently outweighing the fear of supply disruptions. That's the balance right now.
A delicate balance indeed. And by the way, if you value getting intelligence that's really tailored to your specific interests, Nexay has you covered there too. Their platform helps investigators all over the world get deep, actionable insights. Helps ensure you're always a step ahead. All right, looking internationally at stocks, Europe kind of lagged. Euro Stock 600 added just 0.2%. Germany's DAX actually slipped to 0.23%. Some weak industrial data seemed to be the culprit there, though European energy stocks did okay. But Asia, on the other hand, saw a solid rally. That came after the U.S. postponed those higher tariffs on Chinese imports. Tokyo's Nikkei 225 jumped 2.2% to a record high, 42,718.17. Hong Kong's Hang Seng was up 0.3%. China's Shanghai Composite gained 0.5%.
That Asian rally is pretty telling, isn't it? Postponing tariffs, even temporarily, is a big deal for trade-sensitive economies. Gives them some breathing room. And the Nikkei hitting a record. Well, that's not just tariffs, though. It's also the weaker yen helping exports, which, like we said, ties back to currency moves. Shows how interconnected everything is.
True. There was an outlier in Asia, though. South Korea's KOSPI eased off 0.5%. Some profit-taking, maybe, and ongoing worries about China's property sector. And speaking of specific companies pulling back, Cardinal Health fell 7%. Seems there were fears it overpaid in its $1.9 billion deal for Solaris, a cancer care provider. Okay, let's shift to overall market mood. Sentiment. Volatility. The VIX, the fear gauge, it's down about 1.27 points over the past week. Seems to signal fairly contained market stress.
Well, yeah, but this raises a really important question. Is it complacency? The VIX hovering down near 16 and dropping over 7% in 5 days. It does suggest investors might be a bit too calm right now. History kind of shows us that complacency can sometimes precede big market shifts, right? Like a reverse indicator. And August is historically a pretty volatile month. We've got lots of potential catalysts coming up. Hedging demand could easily come back, push the VIX maybe towards its long-term average around 20. It's definitely something to keep an eye on. Are we maybe walking into a classic August lull before things get choppy?
It certainly makes you think. Okay, quickly on real estate and credit. Average 30-year fixed mortgage rate dipped just slightly, 5.9% from 6.0%. In theory, that should help housing demand a little. But inventory is still tight, and affordability is still a big issue for a lot of people. And in credit markets, spreads on both investment grade and high-yield bonds are really tight, compressed, which reflects that risk-on mood we talked about, but it leaves very little cushion if growth slows down, doesn't it?
Exactly. Tight spreads mean investors aren't demanding much extra yield for taking on risk. That's fine when everything's going smoothly, but there's almost no buffer if the macro picture darkens. It's another sign, maybe, of that potential complacency you mentioned with the VIX.
Right. So looking ahead, what should we be watching? Key catalysts coming up. Tomorrow, August 14th, we get the U.S. Producer Price Index, the PPI, for July. Then Thursday, August 15th, U.S. retail sales for July, plus the Eurozone's second look at Q2 GDP. Friday, August 16th, China's industrial production for July. And then, crucially, August 21st, the FOMC minutes from the July meeting. Markets will be digging through those for any clues on rate cuts.
Yeah, each of those could definitely move the needle. A soft PPI, for example, would probably boost those rate cut hopes, help equities. But a surprise jump could lift yields, strengthen the dollar. Yeah. Weak retail sales might suggest the consumer's slowing. Good for bonds, maybe. Strong sales, maybe push yields higher. And those FOMC minutes?
Yeah.
Any hint of hawkishness or even just clear disagreement among policymakers about the timing, that could easily spark volatility. Markets will be parsing every word.
So wrapping things up. You've seen how markets are definitely riding this wave of optimism. Fueled by that cooler CPI print, the temporary tariff truce, equities rallied, yields stayed mostly behaved, the dollar weakened. Almost feels like a collective sigh of relief, as we said.
But as we've kind of explored, the underlying risks haven't vanished, right? Upcoming inflation data, activity data, central bank policy is still uncertain, China's property market issues, geopolitical stuff. It's all still out there. It really reinforces the need for investors to, stay diversified.
Yeah.
And maybe maintain some dry powder.
Dry powder meaning cash on the sidelines.
Exactly. Cash reserves ready to deploy if good opportunities pop up, or just to cushion against potential downturns. It's about being prepared for shifts.
That makes sense. So given that low VIX reading, that potential complacency, and August's history, how might you best prepare for a possible shift? When the summer lull ends and maybe volatility picks back up, that's definitely something to ponder as you look at your own financial picture. Okay, that's it for today's Deep Dive, your Wednesday, August 13th, 2025 Intelligence Brief.